Guys, what are we? Monday, July 13th, 2020. Second half of the year. Q3 has started. Really excited about our guest today. He's been on the show before and it was one of our best shows. Might have been our best show. I am biased because he is related to me. We are first cousins, but he's a fantastic fellow, great gentleman, and a scholar of the accounting practice. Really excited to have him on. Let's bring him in right now. Julien Grenier. He is a partner. He's a CPA. He's a CGA. He's agricultural team manager, and he's a partner at Talbot Associates. Bienvenue. Welcome, Julien.
Hey, Rob. Happy to be here.
Yeah, last time was a fun one. I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management and at the Tatro Wealth Advisory Group. If you're watching on YouTube, take a second to subscribe. We are approaching 2,000 subscribers, and I would love to get there soon. 2,000 would be great. If you're watching on Facebook, share. We appreciate you guys following, and we love you guys, our viewers. Sorry, I kind of half interrupted you, Julien. I apologize for that. We had a good chat last time. It was a fun one, which is why you're back on the show.
Yeah, you know what? It was a whirlwind time last time I was on. I think we were both working from our basements, and it's really cool to see the production value, the intro, all that kind of stuff. Really fun. So you guys are doing a great job.
Yeah, thank you. Good to have you back on the show. Let's get right into it, Julien. Maybe we should start with a Manitoba budget.
Sure.
It was announced in March. 3 major changes. You want to take us through them?
Well, and that's the thing. It's like it's more so things that are unclear at this point, right? So we saw that in the budget proposed in March that they're proposing to reduce the PST from 7% down to 6%. That got canceled because of COVID and the impact that it was going to have. The other 2 tax things that we were seeing in that budget were probate fees were supposed to be eliminated, and there were supposed to be some changes to the health and post-secondary tax levy, which is a payroll tax. So lately we've experienced the fact that some of our clients' probate fees have not been eliminated when they were probating their will.
First, right?
We were expecting it to be July 1st, and so it kind of came as a surprise. It hasn't gone through royal assent yet at the province, so we kind of just took it for granted, and probably shouldn't have, right? You should never take anything for granted, but it has definitely impacted some of our estate planning. So if you have an elderly parent that you decided, I don't need to worry about probate fees because they're eliminated now, and maybe you have an ill parent or something like that, maybe it's time to talk to your advisor to double check to make sure that you've done what you can to avoid or eliminate probate fees. And just quickly, the health and post-secondary tax levy, that's a tax that companies have to pay when their payroll exceeds 1.25 million. So if your payroll is over 1.25 million, you have to report an additional form, and you end up paying an extra 4.1% on anything between 1.25 and 2.5 million. And I believe the other bracket, anything over 2 million, is at 2.1%. So they had proposed to change those amounts to paying those same rates, but at 1.5 and 3 million. Again, we haven't gotten any clarity as to whether or not those will be changed or not. So what we've done here as a firm, we've sent some messages to our MLAs and things like that to get some feedback, because there doesn't seem to be any official stance on if this is going to happen or not, or how that's going to work. So
let me get this straight. You got a payroll of over $1 million. So you're a healthy Manitoba company that's employing probably at least 20 people, I would say, right? At $50,000 a salary. Yep. That be 20 staff, give or take, and you're being taxed another 4% on all of your payroll.
Yeah, it's massive. It's one of the most sneakiest tax that people don't think about, right? Because it sneaks up on you, and it's not something your business is doing good. You got all your margins figured out, and then all of a sudden, bam, 4.1% extra tax. And people are always surprised to hear it, right? But unfortunately, it's there. It's just like any other tax. It's part of what goes into our.
If you're like in a service industry or like an advice industry where that's your biggest expense, that could be 4% right off your margin, right?
Yeah, I mean, a lot of times, like you look at companies that do a lot of freight and things like that. It's no wonder there's a lot of subcontractors in those industries as opposed to wages, right? Because this extra 4%, like that makes a significant difference in those margins, and to be able to compete in those industries, there's some tight margins there for sure.
Yeah. All right. Please take me through the Canada Emergency Wage Subsidy. So there's an update understand it, this is the, what do you guys call it? The CEWS?
Yeah, the CEWS. That's the way I say it normally, or the CEWS. But basically, that's your biggest wage subsidy program that people are using. And so basically, you're comparing your current month's sales to the same month's sales last year to see if you had a 30% reduction in those sales. Provided you are able to prove that, you're essentially eligible to get this subsidy back. It covers 75% up to a maximum of your employee wages. Okay.
How long is this going for?
This has been one since the start, basically, as well. But they're
extended into forever, or is there kind of an end date?
Yeah, so they keep extending it kind of 1 month at a time as they need to. So we haven't heard anything for the September period, but it'll be extending up until August. But the one question that we're getting, so this is a subsidy that's been around for quite some time, but one of the things that's sort of new, not new per se, but more in your face than ever before, is now when you fill out the application, you have to do a series of attestations. I've been impacted by COVID. I've had a drop of 30% sales, and there's quite a few attestations. And then there's this attestation around section 125.7 of the Act, saying, have you elected under 125.7? So from a layman's term, like, what does that even mean? Did I not? And so really what that's covering is that there's certain ways you can calculate your 30% reduction, right? So they said you're allowed to calculate it based on an accrual method. So basically matching your wages with when the wages were earned, or cash when you've paid the dollars to your employee. Okay, those can be different periods.
Creative.
Yeah, so you can't play around with those numbers. You got to, so in 125.7, there's one saying, okay, accrual is default, but if you choose to do cash, you got to stick with cash throughout the whole period of CEWS. Or there was one for your sales. For example, you compare your July sales to last year's July to see if you dropped by 30%. But they had also introduced a measure where you can compare it to your average of January, February average sales. That was for kind of newer businesses that were just starting up and things like that. So it kind of gave you another benchmark that you could compare to. Well, that too, once you've picked that you want to either compare to same month last year or to January, February, the current, you got to keep comparing to that standard. So basically you got your defaults, and then you got your alterations that you're allowed to pick from, but those need to be consistent. So yeah, there's about 6 different types of similar items that 125.7 covers. But yeah, it's not too bad. They are expanding the application every single round to add a little bit more context, a little bit more information right on the application.
Okay, so you're basically your sales are down 30%. You get 75% of your wages covered as a business.
Correct. Up to a certain maximum. So it's like $680 a week, basically, is the maximum per employee.